Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. The biggest business leaders, political voices, economists and stakeholders come together for the biggest post-pandemic gathering to discuss a whole host of things at the 53rd World Economic Forum meet in the snow-clad Swiss town of Davos. Stay tuned for the BTTV coverage over the next 30 minutes. Global interest rates could remain high if geopolitical tensions persist, says RBI Governor Shaktikanta, sounding confident on India's monetary policy stance, says 4% inflation target provides flexibility, sees no need for change as yet. Easing inflation fails to soothe investor sentiment as Dalal Street closes session on weak ground, largely led by lower select heavyweights. Benchmarks end near the day's low. Sensex down 170 points. Nifty fails to defend 18,000. Market guru Saurav Mukherjee adds Al-Kalameen's and ISIS Lombard to his buy list. While speaking to BTTV, he added that he remains bullish on Indian tech and advises investors to accommodate stocks like Poshak and Vijaya Diagnostics. The week-long annual World Economic Forum meet kick-starting today in Davos. Experts, market voices, economists, politicians discussing a whole range of issues, everything from sustainable business models to the future of jobs and gender inequality, among others. In an exclusive chat with Rahul Kamal of India Today Group, World Economic Forum's president Borge Bren says that the Indian economy has seen significant growth, adding that the global economy will grow this year but might see a recession, hopefully just a shallow one.
I want to start by asking you about the broad theme of Davos, where you're basically talking about cooperation in a fragmented world. Many would say that given what's happened between the pandemic and now, with the growing differences between the United States and the Western world on the one side, China and Russia on the other, this is becoming more and more difficult to achieve.
It is true that the backdrop that this meeting is happening against is more complicated geopolitically and geoeconomic in decades. It doesn't necessarily look good, but there are also some silver linings. For example, economy in India is growing quite substantially, is now the fastest growing of the big economies in the world. We're also seeing that inflation is coming down in France, Germany and the US. And hopefully China will grow again quite substantially towards the end of this year.
There was a lot of talk about the certainty of recession, which now seems to be moderating from a certain recession to a fall in growth and possibly a mild recession. Given all the people that you're speaking to in the build-up to this big annual conclave, what's your sense about the overall economic picture as you're reading it?
So I still think the global economy will grow this year. There can be some countries that now run into a recession where the economy is contracting. But if we now see interest going down, more investments, we are also seeing that there are no further fragmentation of the global economy. I think we will come through this year with growth, and hopefully next year we will see some additional growth. But we're not out of the woods yet. It could be also that we see a recession, hopefully a shallow one. But what we really have to avoid is that we repeat the 70s. Then we had a full decade of low growth.
When we'd met in Delhi a few months ago, you'd made an announcement saying that this year would be much worse than the last. Is that something that you're still standing by, or given the fact that China has opened up it the way that it has, the commodity market in China and elsewhere is showing signs of traction, that maybe the worst case scenario won't play itself out?
So the economy, I think, is going to grow slower this year than compared to last year. But we also have the geopolitics. And the geopolitics does not look better this year. It really looks quite challenging. The Ukraine war is still going on. You also have no competition between the EU and the US about level playing field. The EU feels that the US, through this Inflation Reduction Act, are subsidizing its industries. We see that there are also tension on the Indian-Chinese border, not talking about the situation in East Asia with the China Sea, where we see that Japan is now spending more money on the military, and there are tensions there too.
Well, more opinions straight from our Davos coverage. Business Today's managing editor Siddharth Rabi caught up with big voices in the corporate world, Nadir Godrej, chairman and MD of Godrej Industries, and Amitabh Chaudhry, chief executive officer at Axis Bank, asking them what they're making of the economic headwinds and the road ahead.
2023, after a year of unprecedented uncertainty, what's the top-level view looking like from here, even as some people are preparing to ski on the mountain tops behind us?
Yes. There have been problems all over the world. Of course, the pandemic, the Ukraine-Russia war, the huge commodity boom. But the commodity boom at least is largely over, and that's of some relief to India. A lot of the inflation was commodity-based in India. The commodity-based inflation is pretty much gone, and that's why India's inflation numbers are better. And though exports are under a challenge with the global crisis, the Indian economy itself is doing reasonably well. Urban demand is good, rural demand is a bit slow, but expected to pick up pretty soon. And inflation is likely to come under control. I'm more optimistic on this than many other viewers, but I'm reasonably sure that inflation is under control and the RBI is not likely to raise interest rates by much.
Several headlines in that first answer by Mr. Godrej. Amitabh, coming to you, since Mr. Godrej has given us a cue about the RBI not raising interest rates, do you agree with that view in the macro backdrop that we have?
So my view is that I think we're definitely coming towards the end of the interest rate hike cycle. Now, is it another 25 basis points or zero, as Mr. Godrej said? The time will tell. Our view, at least our internal house view, is that it's another 25 basis points.
Yeah.
But new trend which we have also seen recently off late is that some economists have started predicting interest rate cuts in the next 12 to 18 months. And I'm not saying I'm necessarily with them, but you are seeing a clear trend where the economists are...
Does your in-house economist agree with that view?
He does expect some interest rate cuts, but maybe not that quickly. And I'll tell you why. The thing which is worrying me, I mean, I completely agree with what Mr. Godrej said. There are three things which worry me. One, on the inflation itself, while around the world we are seeing inflation definitely trending down with all the action that has been taken by central bankers around the world, inflation could be sticky. As China is opening up, and the way they have opened up, people are expecting stocking up to come back and commodity inflation to pick up all over again, to some extent. Let's see how that plays out. I think the oil-producing countries have shown again and again that they can keep oil prices high, and they've managed to do it.
Lackluster start to the week with benchmarks ending the day in the red, Nifty failing to defend 18,000, closing the day with a 60-point cut at 17,894. Sensex ending the session down about 170 points, around 60,000 just about, as you can see on your screen. Advanced decline ratio today in favor of declines. What are the stocks that were the top losers today? Adani Enterprises, Axis Bank, Hindalco, JSW Steel. Among gainers, we had the IT pack shining today: Tech Mahindra, HCL Tech, Infosys, Wipro and TCS. Here's an excerpt of our conversation with Saurabh Mukherjee. We're then speaking to him on where he's currently finding value in the markets, as well as his view on the road ahead. Listen in.
There's been so much concern about whether there's going to be a marked slowdown and IT companies will only report maybe middling single-digit growth. What did you take away from the TCS and Infosys numbers? Because you have a significant holding in TCS.
A global recession, what IT demand will conquer. So I'm a shareholder in Accenture. We are shareholders in TCS, and some of our advisory portfolios we had Infosys. I haven't seen either in realized numbers from Accenture, from TCS, from Infosys, either in their realized numbers or on their guidance on pipeline or on their recruitment, any sign of any weakness in demand. And the reason for that is not very hard to guess. Trying to sort of be bearish on IT is like being bearish on steam engines in the middle of the industrial revolution. It's honestly as bad as that. Right? At a time when every IT company is telling you that the transition to cloud is only 30% done, at a time when you and I can read in the newspapers ChatGPT is coming, to be bearish on IT is as mad as trying to say steam engines are going to have a bear market for a couple of years, even though this is the height of the industrial revolution. That aside, if you and I do believe that the West is heading into a recession, that presumably increases the pressure on the Fortune 500 companies to outsource even more to India, not less. So I've never quite understood what brokers were trying to achieve last year, but trying to scare people out of IT stocks. We loved it. We bought a little bit more TCS, and in the last 3-4 months in our advisory portfolios, we built a position in Infosys. In my personal capacity, I've owned Accenture for now 20 years, since the IPO actually.
What have been the notable new purchases or inclusions in your mid-cap, small-cap portfolio over the next 3-4 months, over the last 3-4 months, Saurabh, that you can think of?
So let's start with PAT again. So it's notable that the one part of the country where Dr. Lal hasn't been very successful, which is South India. The South Indian PAT market is materially different from the rest of the country. That South India is more prosperous, and therefore PAT and radiology is integrated there. Whereas in Delhi or Kolkata, PAT and radiology is separate, and that means Dr. Lal's business model works very nicely in Eastern India, Northern India. And South, Dr. Lal business model, because it doesn't have radio and it doesn't quite work, and South Indians are too busy to go to one place for PAT and another place for radio. So in the South Indian market, we did a bunch of research for 4-5 months, and we figured out that Vijaya Diagnostics, based in Hyderabad and dominant in Telangana and Andhra, has built a fabulous franchise, very similar ROCs, 40% ROCs similar to Dr. Lal, but great reputation amongst radiologists, the state-of-the-art radiology kit. And as we traveled around Andhra and Telangana, cities like Vijayawada, cities like Warangal, we figured out that this is a kind of mini monopoly in a specific part of the country. So we loaded up on that in our small cap portfolio, in Little Champs. In our mid cap portfolio, we've historically had GMM we've historically had alkyl amines. We've added to that ICICI Lombard on the general insurance side, and in our small cap portfolio, around a year or so, we added a company called Poshak.
Don't forget to catch this entire interview on our other platforms such as YouTube and on our website, businesstoday.in. Shifting focus to key earnings that came in over the weekend, robust increase in net interest income coupled with lower credit costs have driven an earnings beat in the December quarter for India's premium private sector lender, HDFC Bank. Another one from the financial space, L&T Finance Holdings hit a fresh 52-week high on the back of a 39% jump in consolidated profits. The company's net interest income witnessed a 23.5% year-on-year jump to come in at nearly 2,000 crores in the quarter gone by. And from the retail space, Avenue Supermarts came out with a lackluster set of earnings in the December quarter. The retail players' net profits on a consolidated basis show a 6% uptick in December. Total revenues were up 25%, but most importantly, the stock plunged as much as 6% in trade today as margins slipped from 9.93 to 8.3% year-on-year. Staying with earnings from the IT pack, a strong showing from HCL Technologies. The company's product business shines bright despite seasonal weakness. Margins too improved in the quarter gone by, the company expecting waning supply side pressures to aid margins in the final quarter of this fiscal. My colleague Sakshi Batra caught up with the company's CFO Prateek Agarwal to understand the road ahead for the business. Listen in.
It started off on a strong note for you because there's a strong show despite the seasonality factor, and you've been able to beat most of the estimates, especially the revenue and the margins front in Q3 as well. Help me understand what led to this performance, and more importantly, can it be sustained going forward?
So yes, this has been a quarter of 19s, like I called it. 19.6 growth in the top line and 19% growth in net profit. And this quarter, we actually crossed two very nice round figure milestones. So we crossed the 5,000 crore mark in our EBIT this quarter for the very first time, 5,228 crores. And in our net profit, profit after tax, also we crossed the 4,000 mark for the very first time, close to 4,100 crores, 4096 to be precise. So a very, very satisfying quarter. What drove it on a year-on-year basis, the growth in our services business has been fantastic.
Yeah.
That grew 22%, driving the 19.6%. Our software business was flat after taking out the impact of the divested IP partnership that we had with DXC. So services business clearly drew the growth leadership there. As far as margins are concerned, this is a very seasonally strong quarter for the products business. Seasonally a little weak because of the holidays and furloughs and things like that.
Yeah.
So that provides a very nice complementarity at a company level, that the two businesses sort of have a different seasonality which complements each other.
Absolutely. The deal wins have also been quite strong. The company won about 17 large deals, of which the 7 were in services, 10 in the software verticals as well. Do you see the momentum continuing from here? Or are there any signs of, say, the slowing down, pricing pressures, client budgets shrinking right there because of the overall macroeconomic concerns that we've been looking at, going forward from here?
So the macroeconomic concerns have been there for some time, and despite that, I think if you were to look at our last almost 6 quarters, 5 certainly, maybe 6 now, we have had a very steady, slightly increasing, band of 2.5 billion every quarter on the trot. That steadiness is again very heartening because you don't really necessarily like those ups and downs. Ups everybody likes, but downs are not so welcome.
Absolutely.
But we have had that very steady line, and our pipeline continues to be good. We have a good recognition from the industry analysts as well. Like we said in the quotes yesterday, we are the only company who is in the leaders quadrant of all the 6 magic quadrants that Gartner publishes. So that positioning, the passion of our people and our pipeline and our whole set of solutions, I'm sure will continue to hold us in good stead even in the next few quarters. I don't see us dropping outside that band, hopefully.
RBI Governor Shaktikanta reiterating his aversion towards cryptos, flagging concerns around a serious financial crisis stemming from the said asset class. Speaking at the Business Today Banking Summit, he also believes that higher interest rates are here to stay if geopolitical tensions continue to persist.
Would you go as far as to say, given the way inflation is moving and the kind of volatility in prices we are seeing globally, that whole notion of that target band needs to be revisited today?
I would not think so at this point of time. The inflation targeting framework did facilitate maintenance of average CPI inflation at about 3.9% from 2016 when it was instituted, when it started, to the pre-pandemic position in February 2020. So for those 3 years, almost 3 years, the average inflation was 3.9%, close to 4%. After the pandemic, of course, the situation changed. Now, we have had, one after the other major shocks, the COVID, then the war and monetary policy tightening, the current volatility in the financial markets, etc. But I think it's too early to shift the goalpost. The 4% has a certain meaning. And also, let me add that our target of 4% plus minus 2%, to declare it as a failure, if you exceed that, then only it's a failure. I think that gives us sufficient flexibility in our monetary policy decision making. We utilize this flexibility, the Monetary Policy Committee, the MPC, utilize this flexibility embedded in the inflation targeting framework to tolerate higher inflation of 5%, 5.5%, and even more than 5.5%, up to 6%, because the requirement of that time when we were undergoing the stress of COVID and then the, mostly the COVID impact during those 2 years, slightly higher inflation had to be tolerated because the economy required help. The economy required support. We had to infuse a lot of liquidity. We had to also do a substantial reduction in policy rates. So therefore, the current target of ±2% gives enough flexibility, policy flexibility to the Monetary Policy Committee. So keeping that in mind, I would feel that the 4% target with ±2% is very robust. In the Indian context, I don't think there is any need for any change.
I think people speak less about core services inflation. Do you think that could be a fairly significant part of the problem?
You see, core inflation is certainly an area of concern. We have highlighted in the last monetary policy statement, if you see the minutes of the resolution of the last monetary policy committee meeting, the focus was on core inflation. In my policy statement, I had also devoted considerable amount, focus. I had given focus on core inflation. Core inflation still remains sticky around 6%. The number which came out yesterday, core inflation is about 6.1%. The previous month was about 6%. Although the momentum of core inflation within that seems to have slightly moderated, but the point remains that core inflation remains sticky at 6%. And that is not a very comfortable number to deal with. So therefore, we have to keep, as I said earlier, in my last monetary policy statement, we have to be very vigilant and we have to really keep focus on the core part of the inflation, because that is becoming sticky and we have to see, and that is something which has to be dealt with. The supply side measures taken by the government, the easing of supply chain bottlenecks internationally and also within India, I think all these factors will probably have their impact, and the monetary policy action taken which we started in May. I think going forward they should start working in a more visible or pronounced manner so far as core inflation is concerned. But at the moment we have to continue the focus on core inflation, or as I said, the Arjuna's eye has to be maintained on, kept on core inflation.
Your recent comments on cryptocurrencies, you made a statement that they might be triggering the next financial crisis. It could come from there. Do you think they should be banned?
RBI's position is very clear. It should be banned.
All of them. No activity should be allowed in cryptocurrency.
The technology needs to be supported. The technology of blockchain needs to be supported because the technology has got so many other applications. Again, it will become, I can see the clock there, so it will become again a large answer. So I will try to paraphrase it as much as possible. You see, why we are saying it is going to be, apart from the commonly known dangers of, money laundering, terror funding, what are the principal concerns that we have? First thing is, what is crypto? People call it, some people call it as an asset, some people call it as a financial product. But you will agree that every asset, every financial product has to have some underlying. In the case of crypto, there is no underlying. And I had said it in some press conference that not even a tulip, alluding to the Dutch tulip mania. There is no underlying. The increase in the market price of crypto, various kinds of crypto which start at a particular price, then it multiplies over, in a matter of few weeks or few months. It is based on a make-believe that this is worth so much or it will go up to such and such level. So anything without any underlying, whose valuation is dependent entirely on make-believe, is nothing but 100% speculation, or to put it very bluntly, it is gambling.
And that's how we leave it on the show tonight. Thanks so much for watching.